The yield is the warning, not the feature. That sentence is the entire argument of this video. High-yield bonds, what the industry used to call junk bonds before the rebrand, pay more than other bonds for a specific reason. The market believes there's a meaningful chance the issuer won't pay you back. The higher yield is compensation for that risk. The yield is visible. The risk is embedded. The mistake is treating only one of them as real. This video is about what the market is actually telling you when it sets that yield. What high-yield bonds did to a real retiree's portfolio in 2020. And why the retirement income pitch built around them tends to benefit the people selling it more than the people buying it. The gap between a treasury yield and a high-yield bond yield is called the credit spread. That spread is not arbitrary. It's the market's price for default risk, set by hundreds of billions of dollars of institutional capital. In plain terms, the spread is what investors demand for the chance they don't get their money back. If treasuries yield 4% and high-yield bonds yield 7%, that 3-point spread is the market quantifying one thing: the extra return required to hold loans that might not be repaid in full. That number reflects three inputs: how often borrowers are expected to default, how much lenders recover when they do, historically around 30 to 40 cents on the dollar for senior unsecured debt, and how those defaults cluster during economic stress. When spreads widen to 8, 10, even 11%, like March 2020, the market is forecasting a wave of defaults. When they compress to 3 or 4%, like late 2021, the market is pricing calm. In both cases, the spread is information about risk, not a feature of the bond. The bonds themselves are loans to companies rating agencies have already flagged as elevated risk. Below BB plus from S&P. Below BA1 from Moody's. The label high yield describes the coupon. It doesn't describe what you own. What you own is a loan to a borrower the market considers meaningfully more likely to fail. The yield is the warning, not the feature. The most important fact about high-yield bonds, and the one most often obscured, is that they don't behave like bonds. Investment-grade bonds tend to rise when stocks fall. That's the diversification they're supposed to provide. In a recession, investors move to safety, treasury prices rise, and the bond allocation cushions equity losses. High-yield bonds don't do that. Edwin Altman's foundational work on default cycles established the pattern decades ago. The companies behind high-yield bonds are the ones most likely to struggle when the economy contracts. So when stocks fall, high-yield bonds fall with them. In 2008, the high-yield index lost about 26%. In March 2020, it lost about 13% in 3 weeks. Those are equity-like drawdowns from something labeled as a bond. Research across multiple studies shows the same pattern. Most of the excess return in high-yield bonds is explained by equity risk factors, not by a distinct fixed income premium. Strip the equity exposure out, and there isn't much bond left. That has a direct implication. If you hold high-yield bonds as your bond allocation, to balance stock risk, you have less diversification than you think. When stocks fall, the bond side falls with them. The cushion isn't there. The yield is not the benefit. It's the price of that risk. Abstract numbers don't land. So make it concrete. Consider a retiree named Tom. Tom is 67. He has $600,000 invested and needs $24,000 a year from his portfolio. About 4%, a standard withdrawal rate. In early 2020, his advisor recommends a 50-50 portfolio. Half equities, half a high-yield bond fund yielding about 5.5%. The pitch is simple. The bond fund generates most of the income. You can live off the yield. Then the drawdown hits. By late March, equities are down about 34%. High-yield bonds are down about 16%. The portfolio falls from 600,000 to roughly 450,000. Tom keeps withdrawing $2,000 a month. He has to. But now each withdrawal is coming out of a much smaller base. Losses get locked in. The recovery has less capital to work with. By the end of the year, markets rebound, but Tom's portfolio doesn't fully recover because the damage was done during the decline. Run that forward. By 2024, Tom ends up with about $515,000. The same withdrawals, but with treasuries instead of high yield, which rose when stocks fell, leave him with about $585,000. The difference is $70,000. Not from yield, from diversification that failed when it mattered. That's sequence of returns risk. The pitch sold income. The asset behaved like equity. The cushion wasn't there. The yield was the warning. So why does this pitch persist? Incentives. 3 of them. High-yield funds are far more profitable than treasury funds. Roughly 0.5 to 1% in fees versus about 0.05%. Revenue drives marketing. Yield is also easier to sell than total return. This pays 6% is simple. The expected return after defaults and correlation isn't. And advisors paid on assets under management benefit when clients stay in income-producing products instead of drawing down principal. When every incentive points in one direction, the recommendation stops being a judgment call. None of this requires bad intent. The structure is enough. If you're going to hold high-yield bonds, there's one way to do it correctly. Treat them as part of your equity allocation, not your bond allocation. The empirical basis is direct. Antti Ilmanen's work on cross-asset behavior shows the correlation between high-yield bonds and the S&P 500 runs 0.65 to 0.75 during stress periods. The correlation between intermediate treasuries and the S&P 500 during those same periods runs near zero or modestly negative. They are not performing the same function. Treating them as substitutes, which the bond label invites, produces exactly the diversification failure Tom experienced. A small allocation, 5 to 10%, as part of your risk exposure. Not the defensive side of your portfolio. If you can't tolerate a 25% drawdown, the position is too large. If you're relying on the yield to fund fixed expenses, the position is the wrong tool. And if it's being described as conservative because it's labeled a bond, the label is doing the work, not the data. The rule is simple. Treat high-yield bonds as equities, not as bonds. If you wouldn't increase your stock allocation, you shouldn't increase your high-yield allocation. And if someone shows you a 7% yield, finish the calculation they left out. A 3-point spread over treasuries implies the market is pricing roughly 3 to 4% annual default probability across the fund's holdings. At historical recovery rates around 35 cents on the dollar, that's about 2 percentage points of expected annual credit losses. So the 7% yield is an expectation closer to 5% after credit losses, with all the equity-correlated downside risk left over. That's the number the pitch never shows. That's the number you should ask for. The yield isn't a bonus. It's compensation. Treat the asset as what it is. Size it accordingly. And don't rely on it to do a job it has repeatedly failed to do. One last point, because this is where the confusion usually settles in. High-yield bonds do have a place in portfolios. They've delivered reasonable long-term returns. They exist for a reason. But that reason is not stability, and it's not reliable income in the way it's often presented. It's risk. Priced, packaged, and labeled in a way that makes it easier to hold and easier to sell. If you understand that, if you see the yield as a signal instead of a benefit, then the entire asset class becomes much easier to place correctly. You stop asking, how much income does this generate? And start asking, what kind of risk am I being paid to take? That shift is the difference between using the asset and being positioned by it, because the market is not subtle about what it's telling you. A higher yield is not generosity, it's a warning label. And once you see it that way, you can't really unsee it. The yield is the warning, not the feature.